Hello once again, and welcome to Tuesdays with Lloyd's. Today, we will continue our focus on emerging risks and take on a topic that you've probably heard of, but if you're like me, may not know much about, non-fungible tokens or NFTs. Our panel will first define NFTs, what they are, how they operate, and then we'll continue to the many opportunities and challenges NFTs present from a risk management perspective. Please feel free to ask questions during the session using the Q&A tool and not the chat, please. And we hope to have some time near the end to cover your questions. Also remember that all our sessions are streamed live on YouTube and are added to our growing library of specialist topics, all available for your convenient on-demand viewing. So let's jump right in and meet today's panel of experts. Monica Tigleanu, Senior Cyber Underwriter with Munich Specialty. Victoria Dinh, Director of Risk Management at AEG Worldwide, and Jerry Deitz, Founder and President of Ascend Global Incorporated. So Monica, Victoria, Jerry, welcome to Tuesdays with Lloyd's, and the floor is yours.
Thank you, Pat. It's a pleasure to be here with you all. We look forward to discussing the unique and new opportunities within the NFT space as it pertains to business models, utility, and insurance. To start, I want to briefly discuss a broad but inclusive definition of what an NFT is. This is by no means a comprehensive NFT 101 session. However, just to be on the same page, I want to briefly just discuss how I define NFTs. NFTs are a digital token of unique certification of authenticity. You can't copy it and paste it and create it and own it. It is a unique token that lives on the blockchain and gives, as we're about to see, some unique opportunities and utility within the real world space. Even though it's a digital asset, we're able to redeem NFTs for physical items. We're able to use NFTs in business as membership IDs, and they're easily transferable between people. It creates an illiquid asset into a liquid asset as well. So we'll move right into a real world scenario with Victoria and her company as they used NFTs on a large scale in collaboration with many artists at a world-renowned music festival. Go ahead, Victoria, share it with us.
Yes, Jerry, appreciate the explanation on what an NFT is, which is certainly a digital token or asset. And it is true, I'm pretty sure there may be some participants on this particular call who are curious what the NFT is. And from my perspective, my company, which has, hosted many different types of festivals, one which is Coachella, which is a world-renowned festival in the US, and there was an NFT marketplace, which you may or may not have been familiar with. It was the first of its kind for this year, for 2022, and it had many different artists participating on this particular, marketplace, because this product, this unique, asset that could be done for these artists was now digitalized in the cryptocurrency space and in the NFT space. So Jerry and Monica, when a company is trying to promote this type of NFT product, especially on the client side or buyer side, what is your take with how this is presented in the insurance marketplace? Is this something that is willing to be looked at? And I think there is a demand for it, but what is your side of things, especially on the broker and underwriting side?
Yeah, Monica, I'll let you chime in first, and then I'll talk about the broker's perspective.
Sounds good. So from an underwriting perspective, there's quite a lot of newness to the whole thing. So we don't actually see a huge marketplace at the moment for NFTs, generally speaking, globally. We're aware of only about 2.5 million people actually trading in NFTs, whether it's from an art perspective or utilizing, membership type NFTs. the underwriting of this risk actually becomes more interesting when we see traditional business models, let's say even in healthcare or on the real estate side, adopting NFTs to digitalize deeds or build healthcare records into NFTs. So we're looking to understand what NFTs can do currently in this state, like Victoria is describing it as it's used for music festivals or mostly in the sports, media, entertainment space, to then figure out how it's going to be deployed in traditional business models. So at the moment, from a cyber underwriting perspective, certainly we get asked to underwrite from a security perspective, how these NFTs, smart contracts are created. Exchanges are mostly the ones who are looking for some sort of cyber insurance cover. But then we also see a demand in the media liability space for art NFTs or digital art NFTs. And we all have different experiences, whether it's Jerry, Victoria, or myself, in getting that sort of cover because the insurance market is so specialized and siloed in underwriting it. So the various pieces of information that you will need come from different lines of business. In cyber, we look for security controls. In media, we look for contracts, values, how to underwrite that. Maybe Jerry has a specific experience with cover holders that you've dealt with in the past in terms of what underwriting information they're requiring from a non-cyber perspective. Would you like to share with us?
Yeah, absolutely. I think from a broker, you have to, just as any traditional risk, you have to really get your sleeves rolled up and jump into the client's world in order to empathize with the concerns and the exposures that they have to really understand how to approach the insurance market with the type of coverage that's required to meet their needs. And one way that we've been able to do this is we have established a reputation within the NFT space as deep domain experts. We've partnered with cybersecurity companies that are built on the blockchain for the blockchain. And we're currently working with some insurers who have Lloyd's capacity, but they are also deep domain experts in the NFT and Web3 space. We are working on coming up with a way to marry security risk mitigation with insurance capacity. And so some technologies that are out there today are anti-theft in nature. Because these assets rest in the digital world is what needs to be deployed. And technology in the digital world is what needs to be deployed in order to sufficiently secure these assets so that they can be insured. So the insurance capacity right now, if we could rewind back 10 to 15 years and think about cyber coverage, a lot of the cyber coverage was spread out in different coverages. So there was liability, there was ransomware inside of a contingency risk policy, which also had things like Kidnap for Ransom and Kidnap Express. It didn't really seem to all kind of come together. Then you had these really early pioneering companies who they were purpose built for cyber, and they did have a more comprehensive, albeit not popular, cyber policy. And over time, as it matured, cyber became its own standing department. And you, Monica, are in that department, which didn't probably exist 15 years ago. So I think that in the same way that cyber matured, I think we're going to see a rapid adoption in blockchain as a whole, but also the assets that sit on top of the blockchain, such as cryptocurrencies, NFTs, the metaverse, all these kind of new buzzwords that are sort of on the bleeding edge of technology. So I'm really excited about that. So as a broker, from a broker's perspective, you have to roll up your sleeves. You have to get your hands dirty. You have to understand what the client's going through. And then when it comes to bringing that to an underwriter, it's really about, right now in today's world, it is a one-off, bespoke, tailored coverage based on the needs of the client as well as the capacity in the marketplace. There's no standardized wording. There's no kind of broad loss history in an emerging market. So everything is very much taken from subject matter expert to subject matter expert and communicating that up to the insurer.
Yeah, it's the various types of losses, though, that makes it difficult to insure in one division. So if we pick on cyber insurance in particular, as the market as a whole, we try not to write cyber crime insurance. Certainly for small, medium-sized enterprises, there is availability of coverage from a cyber crime perspective, so the actual loss of funds. But generally speaking, it's not really a cyber insurance coverage that we look to underwrite to. So from a crime perspective, we need to engage with crime underwriters that have had to learn the ins and outs of computer crime in order to continue covering things that are no longer cash-based or physical asset-based. So it's a convergence of underwriters' expertise to be able to grasp what NFT risks are all about. But it's no different. So blockchain risk or NFT risk, it's a technological risk. So yes, I agree that the cyber insurance underwriters should have quite a familiarity with what it means to secure the asset and the operations of a business. But as I mentioned in the beginning, I guess Web 3.0 companies that are specifically dedicated to Web 3.0 may be different in risk profile. So you have to look at what they're doing differently from a tech perspective, so the liabilities that they may carry. Also the regulatory risk. There's quite a lack of regulatory oversight for Web 3.0 companies. And I'm sure that's going to be evaluated in the context of the metaverse and what does casualty liability issues, what are those going to be in Web 3.0? But from a just kind of next 5 to 10 years perspective, we're going to see more companies adopt NFTs from a utility perspective. So understanding what that does from an integration perspective on the technological side, you have to go through a digital transformation as the organization that offers NFTs, but also as a buyer or as a client of these companies. So how can users be able to access NFTs in a secure way, how to store them? There's going to have to be a lot of education, I guess, from a security perspective and how to engage with cryptocurrency, blockchain, and Web 3.0.
Yeah, certainly the largest risk is user error right now. The blockchain itself is a technology that is getting mass adoption because of its inherent security. However, user error on the side and the infrastructure built around protecting user behavior on blockchain is still very, very immature. Segueing back to you, Victoria, can you talk to us a little bit about the different types of utility that the NFTs that y'all launched for Coachella offered for customers at your event?
No, absolutely. So we had like a one of a kind specifically for Coachella. So there was, for example, the different artists that were participating, either their art piece that they were wanting to present at the Coachella. There were different artists who were performing, so they wanted to present, their NFT product in the marketplace as well. So there was a wide variety, over at least 50 different kinds of NFT products that were available in this marketplace. And actually you could still purchase it today, even post Coachella, just if you were just curious about the event, if you wanted to be fascinated in that particular field. And I think, Monica, to your point, when we're offering these type of products available, what are some preventative measures and what are some things that underwriting would like to know? And Jared, to your point as well, on the broker side, what are some things you would like to know, as a client, as a buyer, as a risk manager, as we're presenting to you, this is the type of, product that we're going to be moving forward with. Are there concerns? Are there certain things that you may be wary about? And how should we, as risk managers, be able to mitigate that from an internal perspective to be able to relay that internally?
Yeah, certainly. I do think getting ahead of it early is important, given the fact that, again, the wording is not standardized at this stage in the industry. It's important that when you're thinking about deploying an NFT project with specific utility across either one or multiple blockchains, that you get your broker involved, your specialist involved, because there's going to be audits to the smart contract that are inherently beneficial for, and that are going to come up in the underwriting process. And a good holistic kind of underwriting process is going to audit the smart contract. They're going to understand exactly how much vulnerability is built within that, how well is the code written in order to understand how much exposure there is within the contract. Every NFT that is transacted through that smart contract. So it is really the foundation of your project. And if you're going to create a project, the underwriters are going to want to have a look behind the curtain so they know that that's built correctly. That's one of the main things from my perspective. Monica, do you have any other perspective or thoughts on that as well?
No, that sounds plausible. It's having the specialist on the underwriting side to do that. So lots of underwriters are not necessarily developers or code developers. So going back to Victoria's point of engaging with third parties to be able to bring a set of best practices that we as underwriters would look for in order to take that risk, I think is important, but not enough companies are doing that. Lloyd's lab, I did have a quick look at the cohort that is currently been selected. And I guess right now there's no real focus on Web 3.0, but we would suspect that in time, as there's a bigger market and a more need for both the underwriters and brokers and clients to understand the types of risks that they're taking, that there will be third parties that can be true partners to the insurance companies or syndicates out there to build those best practices. It's important though that we don't stay away from taking this risk, I guess, because it is just an evolution of technology. We have seen property and casualty lines of business excluding cyber or technology or computers from their base cover and just looking to cover natural events. So man-made risk is actually probably the most volatile, and we do need to find a solution for it. That being said, there's going to be cautious approach or a cautious approach to underwriting blockchain, NFTs, et cetera, because it's a whole lot of unknown if you're exposing multi-million limits out there. So determining also why you're buying insurance and maybe some of the contractual obligations that may come down the road. Perhaps when clients or potential clients are signing contracts that say you must carry X amount of insurance, there has to be a discussion about the realities of the insurance marketplace and not having availability of maybe specialized NFT cover. It has to fall into the traditional lines of business and what that means. And so I think the reality will kick in that there is not kind of a 100 million available program out there for exchange or NFTs or something of an art project. But you can correct me if I'm wrong, Jerry, if you've seen kind of big limits for programs currently.
Yeah, actually, again, it's a diamond in the rough, right? It's hard to find, but there is a purpose-built insurance company. There's a US-based cover holder that's going to be on Tuesday with Lloyd's, so I won't steal their thunder, but they will be in a few months. They'll be coming on and sharing. But they are purpose-built for Web3. They have, I believe, $3 billion of capacity that they can write, and their minimum coverage is about $1 million. So they're big policies, their institutional cover offerings, and NFT creators, project creators can also be involved. If you have a customer who has a family office with a very large Web3 asset portfolio, that can also be covered. So we're looking at least $1 million in value, right? But certainly not the retail collector, certainly not the retail project creator, but there is capacity today with a very specialized company. Again, as I mentioned with cyber, I think it kind of reflects how cyber evolved as well, where there was a purpose-built cyber company that could probably do similar things that we're seeing in NFTs right now, where the majority of the cover was kind of scattered throughout property and casualty and a contingency risk policy that was then now, as you mentioned, Monica, excluded on all those policies, very exclusively excluded on those policies to be to push you towards that monoline cyber coverage now, which is very mature and robust, which has third-party auditors, which has that incident response, that PR resource during a claim, which has stress testing prior to any kind of incident happening to test the network. I think we're going to see that maturation in the NFT, in the Web3 space as well. Again, there's early players, and there's brokers that are specialized in it as well. But it's just important. It's important to find the partners that you can partner with to see that these steps that companies like Victoria's company are taking to really pioneer in this space, to create a new experience that's digital, but that has real world utility, that's collectible afterwards. I mean, think about going to a music festival and buying a ticket that gives you exclusive access, but then also retaining the art, which has inherent value as well. You're not putting it on your wall per se, but you're able to actually share it digitally. It's what everybody's doing today. It's why the blue check mark on Twitter is so prominent, right? It actually means something, and it matters. And so I think that NFTs also create that utility, and folks that have been to Coachella or purchased an art piece after Coachella have that thing that they would normally stick on their wall. They can display that as part of a community who are fans of music, as those who attend Coachella are.
Yeah, so my question mark would be, and I don't know what Victoria thinks as well, around the need for personal sort of insurance in the NFT space, because there's a lot of, I guess, unknowns from somebody buying an NFT and not knowing how to use it. What is that inherent value? So if actually it's a commercial insurance need, or if there's a personal insurance need, just a question out there for you guys.
I'll take a first stab at it, but I would certainly say that, it may be a little bit of both. I think it's still going to be determined, later on in the future, where that may take. Will it be more commercially based, where the user will be more comfortable, and, the company such as myself, our company that I'm part of, taking on that risk for the user, that could evolve. But I would say it is shared a little bit maybe at this time. But Jerry, what do you think?
I agree. There is absolutely a need, right? There's a retail need for a collector to have insurance, and right now there isn't a really turnkey way to get insurance. If they have a large enough portfolio, it will catch the attention of Web3 specific insurers. However, most people don't have $1 million portfolio of NFTs or cryptocurrency, and so that creates a unique challenge. And I think that some of the things that we're doing may be a solution. I think there's a lot of other companies out there that are kind of pushing the envelope to create an environment where that risk is insurable. But kind of going back to the partnership with crypto security companies, that will allow an underwriter to have a palatable taste of being able to want to underwrite that risk. But right now it is very, very, very wild west. It's open season, right? And so you are there are two type of accounts. Again, I don't want to get too 101 here, but there's a custodial holding wallet and there's a non-custodial holding wallet. So you either have your money at the bank, and that's FDIC insured, or you have it under your mattress at home, and that's not insured. The intrinsic benefits are you can access your money anywhere, and you have full control if it's at home, right? The bank's never going to lock it, never going to hold you from having it. You always have it. But if somebody breaks into your house and steals your money, it's kind of the same in the NFT and the crypto space right now. If you own your own funds in your own wallet, you inherit the risk of those funds being exploited. And there's a lot of what you would see as in the cyberspace, Monica, of social engineering, phishing schemes. There's a ton of that going on in the Web3 space as well. So unfortunately, because it is so wild, wild west, and there's 100 different things that you could do to subject yourself to a bad actor, insurers are not wanting to touch that right now. So getting an anti-theft, getting a technology embedded, because it is all digital, getting that something like that embedded into these assets to where they can be frozen in transit, will be huge for the personal retail market, in my opinion.
Yeah, there's quite a lot of appetite for risk taking, though, for the early adopters of NFTs. So I think part of the underwriter's challenge in looking at this risk is it mature enough to contemplate taking, severity-driven risk? I don't think there's any underwriter out there that just wants to have attritional losses and kind of be money in, money out type of insurance. You need to have some sort of stability. So as we are partnering or intend to partner with solutions to minimize or manage this risk, it becomes a more favorable, let's say, exposure to take on. But I don't know if we referred to user errors in the beginning of this presentation. There's a lot of awareness that lacks when users are starting to get their hands on NFTs, that they make mistakes. They click on phishing links because they don't know what to look for as a authentic project, or they get redirected to different exchanges that are not real exchanges and simply maybe take your money. So there is a kind of what happened at the beginning of the internet approach and what do people want to insure. I thought it was very interesting, actually, that there's some companies that are proposing that we collateralize and we insure the value of very well-known NFT projects. So insurance behind a collateralized loan, right? Because there's a liquidity available for well-known projects, and technically the value is not going to drop as much. There is a marketplace or a potential marketplace for insuring collateralized debt on NFTs, which is a very interesting financial product. But will the insurance market bite, and who, and what are the actual terms and conditions, and the return on those risks is still to be determined.
Yeah, absolutely. There's a lot of avenues and a lot of creativity and a lot of flexibility in the Web3 space as far as moving around liquidity, having liquidity pools, providing liquidity to borrowers. There's just a lot of money Legos that go into that. It's really its own financial system in a way that's mostly decentralized, which needs insurance. The insurance industry needs to help this industry, just like any other industry, just like any other emerging risk, mature. Insurance will play a part in it. And yeah, I think there's some really bright lights in the tunnel about how that's coming together. They're small, but they're bright. And I think they will continue to mature with the industry as well. And those third parties are going to be critical. They're going to be critical to the underwriting process, in my opinion, and kind of mitigating that risk overall. So.
And as, cryptocurrency evolves, and with NFTs and potentially underwriting, being more comfortable, and even I would say likewise with brokers trying to understand what the clients are trying to cover from their perspective, do we believe that, NFTs may be a product, more so on the cyber side, or is it more so on the crime side, or neither? Is it kind of a product that is unique on its own, where it can kind of be its own, division, or, product that is available on the insurance aspect? I think it's too hard to tell, but maybe Monica or Jerry, if you have any insight on what your take.
From my perspective, it requires collaboration. There's a lot of data within the insurance world that is not cross-pollinated. So what crime losses do you see versus cyber incidents versus media liability claims? All of this information tends to be in silos still. So the call for action from a client perspective or a broker to say we need to re-engineer and offer products that are not just from one division to another, but actually just take care of a space or an industry or a phenomenon like Web 3.0 is a call to action that I think most underwriters should be happy with and start collaborating to be able to ensure this, which is why cover holders are generally preferred, because you can actually get the expertise in one place and then get the capital from the different silos within the insurance market. But if we're going to take risk more holistically, there has to be more collaboration between all the different specialties, and also property and casualty as a more generic insurance market. It's going to be difficult, but I don't think it's unsurmountable in any way, shape, or form. It's like any industry, we need to change and adapt to our clients' needs.
Yeah, I think that 2 weeks in this space, in the Web3 space, is like 2 years. And I think that in this niche of insurance that is now a niche that will become widespread and mainstream, I think that they're also picking up the pace of evolution and innovation when it comes to partnerships, collaboration. The data is huge. The thing about blockchain is that everything is visible. There is a paper trail for every transaction. There is, and that's where AI can kind of come in too, because everything is seen, nothing is hidden per se. AI can detect fraudulent activity before a human can detect fraudulent activity. And the same way we have antivirus softwares and network security, none of that really exists in Web3 right now. On the blockchain, inherently it's secure. That network is secure because it's decentralized. However, the users sitting on top of that and the assets sitting on top of the blockchain are not being protected by technology at this time. Widespread. There are a lot of startups, and I think there's some really promising ones. But the collaboration, the data, there's companies that just sit and they just pull the data from the blockchain. So they have an unimaginable amount of data that they're pulling together, and they can put together patterns, and they can put together massive stacks of intelligence that can be used from an offensive perspective when trying to stay a step ahead of the bad actors. And these are people, right? The people are the ones who are causing havoc, who are wreaking havoc in Web3. So just bad intended, people with bad intentions. So similar to a cyber, right? Which is why I think it is digital, it is online, it is Web3, but Web2 is, so they do play together, but I think it will eventually branch off into its own product line, because it will have unique technological challenges and hurdles and things that need to be audited and checked to be fully insured.
I was wondering if we should take any questions at this time.
Yeah.
I thought the first question was really interesting in respect of the valuation of the NFT. Is there any thoughts from you, Victoria, to start, or Jerry?
Yeah, so the question is, when an individual purchases an NFT with respect to, say, to an work of art, they believe they are acquiring the digitized version of the artwork. However, I understand that buying an NFT means one is buying the metadata associated with the artwork and not the artwork itself. How does this impact the way you assess the value of the NFT? And, at least from my initial take, it is true. You are buying that digital piece, and it is associated with that unique piece of art that you are trying to purchase. It is, I don't want to call it the artwork itself, because I think, Jerry, based on the technical side of it, it is digitalized, right? So you're not owning that art piece in the real world. It is already now in this blockchain world where, you do have control of that asset because it is unique in that space. And correct me if I'm wrong on that, but I think that is what this question is trying to ask.
Yeah, so when it pertains to art, you have the original one-of-one art, and then you have prints. Sometimes you have prints, a run of 500, let's say. So an NFT is really similar in that you could have a run of 500, and each of those has a unique serial number. That would be kind of more of a fungible. That's an interchangeable asset. A lot of what we see in the NFT space are one-of-one creations where the attributes of the art itself are unique to any other asset that exists, even though it's from the same artist, from a collection of art. Because it's digital, the artist doesn't have to draw or paint in a unique angle of the same piece of art. They can literally digitalize it and quickly create a unique angle or attribute. They can change a color, they can change an artifact or an attribute of that character or of that scene of the art piece, which makes it unique. So from a collector's, you can look at the history of Christie's auctions and see something that you don't think is very valuable and somebody else does, right? So that does with art, you know, we need some art and species underwriting insight and collaboration, like Monica said, to really understand how to value this. I know that there are some rare pieces that are valued each month because of the increase in the value of the artwork over time. And there has been I think 70% in the last, the value of art, physical art, has gone up 70% in the last 10 years. It's expanded extraordinarily high. And so with an NFT, not only is there utility, sometimes there may be a physical item. You know, we have to think outside the box. It's not just a JPEG, right? It's not just a photo online that we see. That digital certificate of authenticity may be tied to a PSA graded, professionally graded sports card, or it may be tied to a deed of land. There's so much utility with an NFT. So the value, it has intrinsic tradable value because it's liquid. It's a little bit harder to trade a sports card. It's definitely easier to trade an NFT that is attached to that sports card, which can then be redeemed for that physical item. So the value is going to be a tough one. Value is going to be a tough one because when you look at a project that may have 10,000 pieces in it that are all one-of-one unique pieces in that collection, the floor, as it's called in the NFT space, the lowest price to get into that collection may not represent the value of the NFT that you hold. And so again, art underwriters will be key in determining that, and it'll be probably come up with an agreed value, reviewed at whatever frequency the underwriter is comfortable with and the owner of the NFT is comfortable with. But when looking at a whole collection, that's the other unique thing about the NFT space, is that a whole collection would probably be insured over a single piece, because the whole collection kind of sits in the same vulnerability space, right? It sits in the wallet. It sits in it has the same capacity to be stolen or to be lost. And so when a wallet is compromised, usually the whole collection is just compromised at the same time.
I thought another interesting question. I'm not sure if anybody else has any other ones. We're probably going to have room for two more, if I'm not mistaken, in terms of timing. But the next one is, what is the level of cybersecurity and business model maturity for the submissions you have seen in the space? And I guess a quick one for me, because I'm sure that there's quite a lot of opinions around the table, is that there is no way to determine the maturity at the moment because there hasn't been sort of a standardized approach to it. Even when you look at analyzing cybersecurity in other organizations, other industries, not specific to Web 3.0, there is a theoretical secure environment, and then there's the practical security environment of how most businesses operate. And generally, everybody sits on a below average or average security maturity, even though if you compare them against their peers, some of them might be more mature than others. But it is not really a linear best in class, not best in class. I think you have to look at the whole ecosystem, what you're trying to actually ensure. And there's a lot of internal threats as well as user error that cannot be described in maturity levels. So these protections that Jerry was talking about in the first place that need to be developed, technical solutions will probably give more of a flavor from a maturity perspective, because you've put controls in place to minimize the type of loss or to catch that loss earlier. But at the moment, I would say that there is no way to determine the level of maturity. You kind of have to learn more and more about what every company does, and then eventually determine what the maturity is. Jerry, Victoria, any thoughts?
I certainly agree with you, Monica. It's going to take some time. And I think, especially from the risk manager perspective, it's almost like we're doing research as well, doing research, talking with our brokers, talking with, underwriting as well, and figuring out a solution. And I think, with time and as the industry evolves, there may be a solution in the future. And certainly I think, Jerry, to your point, it is happening, and Monica as well, it's getting there. I don't think it's 100% matured yet, but it's going in the right steps of finding places to find coverage. And I think with some of the products that Lloyd's is offering and certain other marketplaces that are willing to expand in that area, I think it is going to be very interesting to see when that time comes.
I agree.
And I think,
there's one more question. How secure is the actual smart contract behind an NFT? Can this be manipulated or altered on chain? And how does this affect the pricing of risk? So this goes back to an audit that would need to be done during underwriting for an underwriter to really understand what they're insuring. So the underwriter would need to have a third party who they partner with and trust to be able to audit them, or they have to have the expertise in-house. Right now, it's more likely that the expertise is in-house and they're able to actually audit the smart contract themselves. The thing about a smart contract, though, is that it can be updated multiple times a day. So there needs to be, to answer your question, the security varies, and it depends on how well the code is written, how well the smart contract is written. If you're familiar, which it sounds like you, the question asker, Matt, you may be familiar with, you sound like you're maybe familiar with Web3 and smart contracts. To ask the question, you'll remember perhaps that OpenSea was exploited through an old smart contract exploit that siphoned a lot of NFTs at a very under market price from users that had listed previously on their platform. So yeah, the smart contracts can be very, very ironclad. They can be very secure if written correctly. But as they're updated and changed for various reasons, there can be vulnerabilities and holes in the smart contracts. So again, for an auditor to review them manually every time they're updated isn't very practical, but that's kind of the take right now. That's kind of what we're having to do right now. As it matures, there will be AI that's able to audit, but there's just not enough white hackers. There's not enough auditors in the space right now to widely audit each individual smart contract. So.
I think there was one last question that was in the chat here. How can an insurer establish the value of any NFT given the extreme speculative nature of that market? And Monica, Jerry, any takes with you on that?
A very quick one for me. It's peer-to-peer marketplace. So I'm not sure if you would manage it through the actual valuation at any one point, or if it's not more feasible to simply put a limit out and then you have to reevaluate either during the course of the year because that's an agreement that you make, or yearly, even though it sounds like it's too far out to evaluate an asset yearly. So I don't know. I do think that this is just another iteration of tradable goods. They're just in digital format. And how did we establish value for anything else? So we have to kind of simplify it that way.
Yeah, I agree. I do think that the value is it can be widely understood in the market, but it can also be very uniquely understood from a peer-to-peer perspective. Whereas the market may see it as this value, but somebody's willing to pay this value for it. And that could be 2, 3, 10x of what it is. So I would say it's volatile. I don't know that it's entirely speculative if we're talking about blue chip NFT projects. Certainly you can be speculative on unvetted, unproven NFT creators with all kinds of promises. But I think that maybe 2 years ago it was more speculative, but now there's been some real maturity, even though it's still relatively immature. There's still been some real maturity that makes it more of a volatile space as opposed to a speculative investing kind of space. So.
Okay, well, I guess that sort of wraps it up. I want to really extend a big thank you to each of you, our panelists, for sharing your time with us today. It was an excellent session, fascinating. I learned a lot. So again, a very big thank you for joining us today. And that will do it for us today. I hope you found the session as fascinating as I did. Be sure to join us next Tuesday, the 24th, when our topic will be parametric solutions in the event of pandemic, business interruption, or natural disaster. Our session will be led by Tina Kirby, innovator and senior underwriter at Munich Re's Syndicate in a Box. And then join us again on June 7th when we will tackle digital transformation. As our session ends today, please take a moment to fill out the few feedback questions that will appear in your browser. And of course, you're always welcome to drop us a note anytime at usevents@lloyds.com. So let's all keep staying connected. And until next Tuesday, take care and have a great rest of your day.